Let's talk about the latest trends that I've seen. I mean, looking at your year, I think you've had several mergers happening even the previous year. So there's a lot of mergers and acquisitions. Of course, not just here, we also seen our local banks doing the same in the regional sectors. And it's quite prevalent, which is good. But I actually wanted you to tell me whether this is good for the market or not. And I think I wanted to mention an example, SMEC, taken up by Hope. I also saw Credit Bank by Showcap and all. I was curious to ask you, I see microfinances and some of our, shareholding being taken up by, what we call foreign investors, when we call them that. But of course, there's also a balance because I've seen our local banks as well take up some regionally. What does this indicate for you as a CEO and looking at all these banks? Is it just normal market players coming into play, or are there concerns?
I think concern certainly no, because it's a good sign, it's a good development. See, what tends to happen is that, and as I mentioned a little bit earlier, for banks to withstand the shocks, they need to have some things in place. And one of them is capital. So they should be adequately capitalized to be able to withstand any shocks that, come into the market. We have got things like asset quality that also, become handy in that kind of an environment, but also the liquidity. Now, the bigger the bank, the more likely it is that you have got adequate capital to be able to withstand the shock. So the bigger you are, the more likely it is that you've got adequate capital. Not always, but in terms of the adequacy of the capital based on the asset book you're holding. So the bigger the bank, the more likely it is that it's got adequate capital. And then the other thing is the fact that for liquidity, you see, banks leverage on their size or their branch network to be able to pick deposits from wherever. And so you find that, for example, the Kenyan market, the bigger banks have got no problem in terms of collecting deposits. And especially the current accounts which are almost like cost-free. So they really leverage on that size to be able to pick cheap deposits from the market, and therefore they then use it to their advantage. Now, the smaller you are, the more likely it is that you'll be having challenges on the very same things that I've mentioned. To see. So it will therefore make sense for you to combine with another entity, and therefore become a bigger entity, and therefore be able to have a chance to withstand the competition in the market. So be it in terms of your capital adequacy, or be it in terms of your asset quality, or be it in terms of your liquidity levels. Those are, so to speak, ammunition that you use for purposes of competing in the market. And the bigger you are, the more likely it is that you'll be able to compete in a much more you'll be much more competitive in the market. You mentioned something about Kenyan banks moving into the region. And that's being driven by two things. One is the fact that, as I mentioned a little bit earlier, the size matters. And so you want to exploit the opportunities that are arising in the East African community market. And so you want to expand yourself into markets that are looking attractive for you to be able to perform better. And that's why the markets like, for example, in DRC, markets like South Sudan, of course it has got its own challenges, but the other markets of the EAC, the Kenya, the Uganda, Tanzania, they are fairly attractive for Kenyan banks. So in terms of expansion, those are the markets to target. You see, but then there's another factor as well that is motivating Kenyan banks to go into those other markets. You see, the East Africa now is a community, is the same. So you'll find that actually you've got your customers who are operating from Rwanda, your customers who are operating from Uganda, from Tanzania, from Burundi, some of them from DRC all the way coming this way. Now you want to move closer to the customer. So you then open operations where the customer is. That's why you see this expansion into those markets, because banks are chasing their customers into those markets.
I see that. So two-part question as we come towards the end of the conversation. The central bank yesterday, I mean, the governor was on record in Parliament saying that we have a lot of unregulated, mobile credit, who are already operating, and that was quite a shocker. And I'm sure for you, sitting on behalf of the banks, that should concern you. I'd like to hear your comment on that, but also comment on the fact that CBK as well raised the transaction limit for mobile money, citing increased financial inclusion and support for business limited by mobile money. So how are banks responding to these changes? of course, vis-a-vis with what we are seeing the central bank talking about, the regulation aspect of some of these offers? Yes.
I think first on the issue of the digital lenders, in the market. I think one is that the digital lenders are already in the market.
They were,
before regulation caught up with them.
Oh,
you see, they're already operating.
Okay.
So it's not like the regulator is already there, and therefore anybody who comes into the market has got to get licensed before you can start operating. They're already operating. And then the regulation was changed by allowing central bank to have powers to actually regulate them.
You're right.
And so the first step was to ask those who are operating to actually apply for licensing.
Yes.
You see, and then you are given time within which you're supposed to apply for the registration, or else if you don't apply, then you have got to cease operations. And then there are those who are now coming onto the table after the regulations are in place, and therefore they have got to first of all get licensed before they can start operating. You see. Granted, in that kind of a scenario, you'll get that there will be quite a number of players who are already in the market who are fearing the conditions that central bank gives, and therefore they still operate underground. You see, and then there are also the newer ones who are coming in and seeing the regulation, and therefore preferring to operate underground. And those are challenges that I think we'll have to face as we go along until we finally bring all of them into, because there's got to be a way in which anybody operating outside the regulatory framework is punishable.
You're right.
You see, and normally some of those guys is very difficult to reach them, but eventually they'll be reached. But having said that, I think the critical thing was the fact that it was the right step in the sense that there were a number of challenges that were coming out of these digital lenders, and that blame was actually being put on the banks, because the banks were being seen. Anybody who borrows knows that I've borrowed from a bank. You do not know that you're borrowing from a money lender who is not registered anywhere.
That's true.
But when the blame comes, it's sort of like the banks are seen to be, the ones who are at fault. A number of malpractices, some exorbitant interest rates were being charged, some uncouth recovery processes that were being followed by these people. In terms of confidentiality, in terms of the information, you get information flying all over the place. And those were malpractices that banks were suffering the wrath of without being the ones involved. So with the now regulator coming in and raining on them and trying to bring them under some order, for us it's a very positive development, because now we are all operating under some sort of like framework, and any misbehavior can easily be pointed out, and therefore you can be picked out and appropriate action taken for correction of the action. I think so. That's a good development. On the other point that you raised about the increase in terms of the limits, and therefore, the evolution of mobile money has got a positive effect on the banks, because banks were able to leverage on mobile money to be able to provide mobile banking. You see, absolutely. So like for example, right now, if you pick on M-Pesa as an example, a number of banks are actually into partnership with M-Pesa to be able to ride onto the M-Pesa platform to provide their lending services, their various banking services. So they are actually operating in unison. You see, now when the limits on how much can be transferred through the mobile money is increased, it therefore means that actually the bank can be able to transact through that channel with big amounts. You see, so for example, now you can disburse a full loan on an M-Pesa platform.
You're right.
You see, initially you either had to break it into bits and disburse first disbursement, second disbursement, third disbursement for you to disburse a full amount. But now you can be able to leverage onto the M-Pesa platform and disburse the full amount to the customer without any problem. The only challenge that comes in is on things like, for example, the money laundering and countering financing of terrorism. Because you see, the controls that banks go through from a regulatory point of view are adequate to provide comfort of the fact that it's not it's not porous to money laundering and financing of terrorism.
Yeah.
Now, the nature of mobile money is such that you cannot have those very detailed checks and controls that you're supposed to have, like you have in the banking sector. So, and that's why sometimes you have got to be careful on how much limit you put there. Because if the controls are not as tight and you're putting a very high limit, it can easily become an avenue for financing of terrorism and money laundering. So money is laundered from the economy and passed in through the mobile money, and because of the weak controls, you've got no control over it, you see. Whereas you've got enough controls in the banking sector, it's unlikely that money will be laundered and passed through the banking sector without being detected. But it can pass through the other system and it won't be detected. So it's a balance that you have got to strike.
And we seriously applaud the movements. Finally, we cannot close our eyes to what is happening globally, and we have seen solvency events in the global banking sector, sometimes which are quite alarming. You hear news in other countries and what is happening. Is it time from your end that we increase the minimum capital requirements for local banks just to be safe, and bearing in mind that our local banking capital requirements are still, lagging our EAC neighbors who have recently increased their sector minimum tier 1 capital requirements?
Well, it's a debate that has been with us for quite some period of time. There is the issue of the fact that when you increase the capital requirement for a banking institution, there are some banks, for example, that will just not be able to meet it. Therefore, they either have got to close or combine, as we were talking about earlier, combine with others to meet that capital requirement, or some form of combination. Now, those specific banks that are operating in that zone, they also serve a particular purpose. They also have their own niches that they serve, and those niches cannot be served by the larger banks. So it's a decision you're going to make. You either want to cut those niches off, and the risk you have is that they'll then go underground and not go through the formal channel. And informality is one of the biggest risks that we have. Informality breeds things like money laundering and financing of terrorism. There are also other risks, like, for example, tax evasion, all those challenges. And you would rather have money flowing through the formal channels than the informal channels. So it's a decision you make. You want to have strong, well-capitalized banks, and therefore increase the minimum capital, well and good. But on the other hand, you are shutting out those smaller ones, and those smaller ones serve a particular niche, a particular market, a particular need in the market, which then will not be served. And so it's a balancing act you have to make.
Dr. Habil, thank you so much for your time.
Thank you.
Very well. There you have it, Dr. Habil Olaka, the CEO right here at Kenya Bankers Association. Very optimistic that we are at a good place and looking forward to an even better future. Thank you so much for your time. I leave you now with the markets.